This is a story of microfinance institutions impacting communities all over Indonesia. For thousands of microfinance institutions in Indonesia, their main client base is the surrounding local community. When business is good, clients can repay their loans and keep money in saving accounts. But Indonesia is a large archipelago, spread across the Ring of Fire and prone to earthquakes with often devastating impacts. Over the past 100 years, there were 96 major earthquakes, causing around 300,000 fatalities. This is almost one major earthquake every year. Economic losses caused by the recent 3 major earthquakes was $10 billion. Around 133 million people live in or near high-risk earthquake zones. When earthquake hits, communities, homes, and businesses are impacted. Many clients withdraw their savings. They face trouble repaying their loans, and this often causes liquidity crises for the microfinance institutions. After the 2006 Jogja earthquake, some microfinance institutions received no loan repayments for 3 months after the earthquake. It took 1 full year for the repayment rates to return to normal. In Aceh, non-performing loans for some microfinance institutions in the area went beyond 20% after the 2004 earthquake, taking them several years to recover. The impact of earthquakes are felt more by microfinance institutions with limited geographic operations, as one earthquake in the area can affect all their borrowers at once. Microfinance institutions play a key role in the recovery of a community after earthquakes, when funds are needed quickly and urgently. Preventing liquidity crises and helping them stay in business is where earthquake index insurance comes in. With earthquake index insurance, the microfinance institution buys insurance to protect their loan portfolios from potential liquidity crises after earthquake events. The insurance payout is triggered by predetermined earthquake parameters, intensity, and magnitude. Intensity is expressed in Mercalli scale or MMI, designated in Roman numerals from 1 to 12. Both parameters are announced by an independent and established third party like the BMKG or USGS. If their loan portfolio is located in the affected area, they receive an immediate payout. This is different from traditional insurance. It cuts the need to wait for an insurance agent to come and conduct a loss assessment in order to validate the claim. Microfinance institutions can benefit from this immediate payout to mitigate liquidity crisis and continue lending to their community. In this way, earthquake index insurance can help microfinance institutions be more resilient and help plan contingencies in advance of natural disasters. It can also help microfinance institutions secure and expand access to financial services for the local community, and ultimately be a part of protecting the livelihoods of small businesses and low-income households.